Multifamily syndication or group investing into apartment deals can be incredibly lucrative. But the problem is, most investors don't fully understand how they actually get paid. Terms like preferred returns, profit splits, and capital stack can be confusing, and that confusion leads to hesitation or missed opportunities. Today, John and I are going to be breaking down exactly how investor returns are structured, how profit gets split up, and what you need to know to make smart investment decisions. John, it's great to be here with you.
So good to be here, Mark. Yeah, this is a common issue in a lot of industries, right? There's these terms of art. And so sometimes the operators are too fast with those and don't ensure full understanding, right? When they're talking to a potential investor. So we see it in every industry. So today we really want to break it down because at the end of the day, it's pretty simple, right? It's just these terms can be confusing. So we're going to add clarity. So you're listening to this, you can make a really intelligent decision. And one really smart decision you can make is actually to go to fulloutinvesting.com. It's a specific website we set up. There's no fluff. It's just all action. So there's a 50-minute video you can watch. Pro tip, you can do it at 1.5 speed. But it's going to give you a full understanding of everything at Faris Capital Partners, how we specifically target these deals, but also demystify the entire process, whether you're investing with us or somebody else. We also have a sample deal on there, so you can kind of see what a typical deal that we do looks like. And if you find yourself intrigued, you can book in a call to start the process and get on our preferred investor list. So definitely go to fulloutinvesting.com.
Perfect. Yeah, John, this one is going to be really good because I found, when I was investing in real estate for many years, we built up a portfolio up in Canada, and then as we started coming down to the US, I started diving more into the multifamily space. And it's like I noticed that the syndication groups or the operators, they were using these lingo words, right? And it was almost, it's a different language. And so when you start diving in, it's like, okay, it's pretty simple. You just need to study what those words are. And so one of the things when we launched our company a number of years ago, John, this was like you and I, we got in a room, we hashed it out and said, what do we want our company to represent? And so one of the things that we talked about is like, we want to keep things simple. So one of the things, whenever we're communicating, is like, that word that you use there, I know you know what it means, but like, what's a more simple way to say that so that our investors that aren't studying this other language can understand on the first time? And so we never want to say a word that is like, I'm not really sure what that means. Or, when John, you get in a group and somebody says something, you kind of nod your head like you know what they're talking
Right.
about.
Yeah.
Listen, we know the lingo on our end, but as an investor, that is not, you're conquering your own lands, right? And you shouldn't have to go figure out what words mean. And so as a company, that's John and I, that's our commitment, that we want to simplify the industry jargon and filter it so that when we say structure a deal and we're going over an actual deal and what all the terms and the breakdown actually looks like, it's in a simplified manner that investors can truly understand. Because John, this is actually a tactic that the financial industry, not all groups, but that is like a known tactic to create these, we'll say, complicated, the jargon of the industry. And it's like, they'll talk to you that way. And it's almost like it's an approach to make you feel so stupid that you just need to hand your money over to them. And it's like, here, take it. I don't know. It's too complicated. I'm going to go over here and make more money. And you just invested. And I hope everything's going to be okay.
Yeah, that's right. It's 100% accurate, especially in the financial services industry, right? They want to make it seem almost more complicated. So it's like, I need this person, right? That's how they're earning their commission. So you're dead on, Mark. I would say that maybe in some cases it's not intentional, but I do think there is, a bit of that certainly happening, right?
Yeah. And I don't want to like throw a blanket over the
No.
industry because we actually have a number of financial advisors that are really strong investors and they run a phenomenal business. It's just, I've been in a room with a financial advisor and I'm just at the end of the conversation, there were so many different words and it didn't work out very well for me with that particular financial advisor. So there's good and bad, like in any industry for sure. So there's a place for, really good financial advisors. But the point is like the simplification of that and to honor who you're speaking with. And John, that's one of the things that you and I, we've talked a lot about this as well, is that when you know something so well that you can simplify it to the simple. What I mean by that is like the best books that are out there, they're able to break down the words in a way that everybody can understand, like a 12-year-old can understand. And so whenever I see big complex words in when you're reading something, to me that's not as strong as if you can take a complex word and or a complex idea even and simplify it. It kind of goes back to, if I had more time, I'd write a shorter letter.
Yeah, that's right. Yep, that's it, man. No, and it's one of our fundamentals, actually, Mark. So we've touched on fundamentals before. Those are the behaviors that define our values, and one of ours is to communicate clearly, right? Just make it real simple and easy for people to see what we're doing and what we're working on. So it's something we think a lot about. So in today's podcast, we're going to talk through some of these terms and help you get that deeper understanding, so it's not maybe so daunting as you consider your next investment opportunity.
So, John, first word, syndication. It's like, it seems like a very daunting word. Whenever we say syndication, it's like we understand what it is, but the problem is it sounds very scary. And so, what does syndication mean?
So in my mind, I mean, the simplest way to talk about it is just when a group of people come together with a common goal in business, right? So they're pulling their capital together to do something that they couldn't maybe do individually or wouldn't want to do individually. So, really at the end of the day, what we're doing is we're a business buying a business, and our investors are buying shares in that business. That's the simplest way to think about it. So no different than buying a share in Apple. You're buying a share in this real estate asset when you participate in a syndication. So that syndication is just what, the term, right? It's just bringing a group of people together with a common goal and a common purpose. That's how I think about it.
Yeah.
I don't know if you have any insights there
Yeah,
to kind of add
for
further
sure.
clarity.
And from a simplified version, that's it. You got a pool of people working together to take down a big deal. And that's actually, John, when we're started looking at these large deals, the Black Rocks were buying, the big insurance companies were, the institutions were buying them. And really the syndication model was a way that everyday investors could team up and they could actually go and compete with the big boys. And so that's
Yeah.
why I love, syndication, although it seems like a little daunting, the word, that approach of like pooled investors has, we'll just say, allowed us to go toe to toe and to compete with these larger investors. So to break it down, you really need we'll say, a leader of the overall group. So a key decision maker, and that's what we call the general partners. And so the general partners are the ones that are actually running the deal. And then the investors, where their part of it is to bring in the actual investment dollars. So the general partners go out and find the deals. They build the relationships with the brokers. They do all the due diligence, the analyzing. They make sure it's a good deal. They package it up. They get all the securities compliance there. They go through, and they actually are responsible for collecting all those the investments as well. And then they actually run the deal from 3 to 5 years, and then they're tasked with choosing when the right time to sell. So they're making the decisions on behalf of the limited partners. And so the limited partners, one would say, well, why limited? What does that mean? Limited means that there's limited liability. And so this just means if there's any sort of lawsuit that happens, somebody trips and falls, and the limited partners will not be classified in that suit. They will not be in that group there, because the extent of their liability is the amount of money that they're investing. So worst case scenario, that's what they have involved. They're not going to get sued above and beyond that, the amount that they have invested. And so the general partners are basically doing all the work. And in a lot of cases, I mean, John, you and I, we invest in all of our deals as well. But the bulk of the investment, because, we're looking at a deal right now, and it's a $14 million raise. And so for us, John, you and I, like, that's going to be one of 5 deals that we're going to be taking down this year. And so, we have funds in the kitty, but we don't, $14 million on over 5 deals. That's where we bring in other investors. And the beauty of this as well, the limited partners get access direct to the deal. And the way that we're going to break down the profit splits as well, the limited partners actually get more of the upside than the general partners because how large the deals are. So you have the general partners running the deal, and the limited partners are the ones that are actually providing the capital. And then they get to go conquer their own lands. They don't need to worry about managing the deal and all the rest of it. They get their monthly updates. And so the accredited investors and the super successful entrepreneurs that come into our deals, they're out conquering their own lands, and that's why they love these deals so much. Is they get majority of the upside, yet they don't need to do any of the work.
That's right. No, you nailed it, Mark. I mean, really, to put it simply, the general partner manages the deal. The limited partners are the key to provide that capital. And based on the structure that is within that deal, all investor groups have different structures, right? So maybe a different preferred return, a different equity split, et cetera. So that's something you really need to hone in on as an investor. But that's where your participation starts and stops. So in other words, you nailed it, right? Like you're not having to worry about the mortgage or the insurance or a slip and fall or something like that. We take all that on, we take all that liability on, and we manage all of that process.
Yeah. The higher net worth individuals, what I found is that they want to make sure that their capital preservation is like that's really important, that they don't lose money. It goes back to Warren Buffett, right? Rule number one, don't lose money. Rule number two, don't forget rule number one. So capital preservation is really important. But the other thing that's really important, because they have large holdings, they're like, I don't want to be sued.
Right.
And I don't want any sort of investment that I'm getting into. I already take enough exposure on, maybe my business or whatever, but when they're investing, they don't want to be pulled into anything. And the other thing that is really important to them as well is their time. Like the investors that are coming into our deals, John, as you know, like these guys are like $1,000 an hour guys. So this is something that we want to make sure that we're taking all of that exposure off of them and that we're doing all the work. And so for us, what became very important with so many investors relying on us, John, this is where you and we took a lot of responsibility. Well, ultimately, we have to take ultimate responsibility, and we did. But we spent a lot of time finding the right team members, pulling them together, curating like a strong company that can actually go through and execute on these deals. And that's where we found from finance to make sure that our tax slips are on time at the end of the year, to cross-border taxes, because we do have a number of Canadian investors investing into our deals along with our American investors. So both sides of the border are looked after, to the asset management side, to executing on the business plan side, to finding the best deals and underwriting and building relationships and tying it all together as well. And so we spent a lot of time, and that's actually, John, one of your best gifts, and I've said this a number of times before, is like finding talent, bringing them on board, and to be able to onboard them effectively. John, that's one of your best skill sets, one of the best that I've seen in the business world.
Yeah. Thanks so much, Mark. No, it's something I actually take a lot of pleasure in. In my view, any successful business is, their results are tied to the strength of the team. It's no different from a sports team, right? And I know you played sports professionally, so you firmly get that. But, 1 week, sort of cog in the wheel, the whole thing could break down. So not only ensuring we bring the best talent on, but we provide them with all the tools and resources they need to be successful. We support them. But yeah, hiring is an interesting thing. And it's something that, with the wrong attitude, you can say, oh man, I got to go through this process, right? But I look at it like I get to go through this process, right? It's an opportunity to meet people, learn. Some of my ideas often come from interviews where maybe we don't even hire the person. They're not the right fit culturally, but maybe they just say something like, that's a little nugget. That's a great idea. So, I view it as an exploratory process. And when it really works well, you bring on folks like Georgia, Joe, Madison, Treese. I mean, I can really name everybody on our team. And it's truly a pleasure every day to come to work. I mean, it's not without its stress and challenges, of course. But when you have the right people that have the same values, right? It's not so much that I get what your values are and I can do that. It's more so it's just already inherent in who they are, right? In other words, I can't teach somebody to have a genuine love of people. That needs to be baked into their very essence, right? And so when we have a hurricane, coming towards one of our properties potentially, right? For example, in Largo, we had, a couple that were close. And now, for a variety of reasons, we had no issues because we bought this asset in a great area where it was not prone to flooding. And I can keep going, all the maintenance things that we do along the way to protect. But nobody had to tell Georgia to check in on every resident and ensure that they were good, right? That they, look, some of our residents are hourly employees, right? And, maybe their hours get cut back because there was a disruption at the business. And so checking in, it's smart business because number one, I'd rather know we may have somebody it might potentially get a little bit behind on rent or may need to use a flex pay option. If we can get ahead of that and build a plan and monitor it very closely. Because at the end of the day, we're not running a charity, but we still check in. But the main benefit is the resident feels appreciated. They see that we care. and they're going to be more apt to do whatever it takes to solve that issue because we came to them and said, hey, look, we're willing to work with you here. How's everything going? How's your family? Are you guys good to go? But it goes back to, if I hired somebody that couldn't care less, they're not going to do that unless I tell them to go do it. And that does not work in a scalable business, right? At the end of the day, you and I can't be telling everybody what to do at all times. They just need to
Right
know
on.
what to do. Yeah, that's
Yeah,
right.
for sure. So we got syndication here. We went over limited partners. We went over general partners. The next one here is how do you get paid in these deals? And so there's cash flow, and then there's a profit split, or what they call waterfall structure. So cash flow in our deals, what they look like is in that 5, and it kind of ramps up to like 7-8% by the end. So on average, it's in around that 6% range cash flow that's coming out over a period of 5 years. That's average. And so then on the backside, there's a profit split that is paid out, and that's from the profit of the sale. So the way we run these deals is we buy them, and then we renovate them. We have a business plan. So we increase the overall net operating income in the property, and then we look to sell them in 3 to 5 years. And then when we sell them, what happens is that's where the bulk of the overall profit was paid back to our investors. And then from there, we present another deal that is another value add deal that we can go in and do the same thing. So rinse and repeat. This is not a complex business, but it can be boring. It can be very boring because these are long deals. This is not like you wake up one morning, you get excited, and then you quit the next day. This is like, could be a 5-year project. And so what I found to be super important, the execution over a sustained period of time. And so the key there is to hire the right people and to ensure that those right people are executing on the right systems and processes to be able to be consistent over a sustained period of time. And so this is something that there's 2 ways you get paid. There's cash flow and profit split at the end. And so the way that the profit split in the end works is that we actually offer a preferred return. So what does preferred return means? It actually means when we sell the asset, all the cash flow that actually came through and was paid out to the investors, so it ranged between that 5 to 8%. So if we say on average it's about 6% on an annual basis, what we do is when we sell the asset, the investors get an 8% preferred return, which means that if they had 6% that was paid to them along the way on an annual basis, that means that we need to top their investment up with the first fruits of the investment is paid to the investors to top them up to have an 8% annual return. Let's say if it's a 5-year hold, that means that if they had 6% on average over the 5 years, we need to top them up 2% per year over those 5 years. So that means that they had 8% annual return. And so that is the first, we'll call it waterfall structure. That bucket needs to be filled up for investors to get that first 8%. Now, John, this to me is one of the biggest reasons why investors should be thinking about these types of investments, because if you go to your financial advisor and say, hey, listen, I'm going to give you some money here, and unless you get me an 8% return, then you're not going to get any of the back. You're not going to get any profit. You go okay with that? They would be like, that's silly. We tell our investors, unless you get an 8% preferred return, we're not taking any profit on the back end. That to me is we call it a catalytic mechanism. So to simplify, it forces us to deliver on what it is that we're promising. It's kind of like it's like a built-in small guarantee. The word guarantee from a compliance standpoint should never be used, a guarantee. Although we do have a guarantee with communication, unless we are able to deliver an update on the 30th of the month, we tell our investors that we'll buy them dinner if we're one day late. So that is a guarantee. We can say that. But overall, guarantees, there are no guarantees in any sort of investment, even if you put money in the bank. Ultimately, if there's a run on the bank, I know the government can say, we're going to guarantee the funds, but at the end of the day, if the government went bankrupt, then what's going to happen? And so ultimately, there's always some sort of risk in any investment, but the 8% preferred return and that first waterfall structure, that bucket getting filled up is massive. So
Yeah.
I'm going to pause there, John, let you fill in anything, and then we'll keep going on the waterfall structure here.
Yeah, I think just to put it simply, that preferred return is really the baseline return investors will get before the general partner sees a dollar, right?
Yeah.
So it ensures alignment. And so for us, we're incentivized to make sure the returns are maximized because up to 8%, we're not getting a dollar. And so even above 8%, we'll get into how we structure our deals beyond that. But it's just that idea that there's total alignment and the investors get first priority when we exit these deals and that we ensure that they get taken care of. So it's really just a way of saying investors get paid first when it comes to these deals, right? So you nailed something early on that I think is worth repeating is that Mark and I actually put our own capital in these deals alongside our LPs. So there's further alignment there because we're putting our own money on the line on these deals. And so the GP's aligned, but Mark and I are also right alongside you as an investor in our deals. So I think that's important to note. So just to put it simply, $100,000, and we generate beyond an 8% return, you're guaranteed, to get that $8,000, right, on that annual basis over the course of that 5 years before we even see a dollar, right? So I think that's how I would think about it. It's your first in line as an investor.
Yeah, exactly. You get you're ahead of us on the capital stack. And so when you say capital stack, if you think of the funds that are actually coming into the deal in the order of who's going to get paid first, a capital stack, you have the lender they're in first in line, and then if you do any sort of, we'll say, we call it preferred equity, which kind of sits next in line, which means that they're maybe getting like a 14% overall return, but they don't participate in the upside. We don't do that. We've done that on one of our deals, but the other deals, we in general, we don't do that. But the next in line was you have your investors that are coming in, limited partners, and then you have the general partners there that come in after that 8% preferred return, and then there's a split. So
Yeah. And I think
$100,000. Yeah, go ahead, John.
Well, I was just going to say, just on the preferred equity component, just for that investor that's not familiar with that term. So there's investors out there that will put their money up in that preferred equity position. Now, I almost like to think of preferred equity as just another form of debt, right? Because it's basically a return that we agree to on the front end, so a current pay, so typically in line with our cash flow distributions, and then when we exit, there's an accrual that occurs. So it really depends on the market you're in. Some offer different rates just to be competitive. Right now, you're seeing preferred equity somewhere in the 13 to 15% range, maybe even 16, with about half paid current, half paid in accrual at exit, but they don't participate in the upside. But if you see, as an investor, you see preferred equity on a deal, it's not a bad thing, but it's just a pause moment to just ask for some further clarity on that structure and how that could potentially impact your returns as a common equity investor. But to me, when I think about preferred equity, I really almost think about it as just another form of debt, even though it says equity right there in the name. So that goes back to sometimes these terms can be a little bit confusing, but it's almost like another way to get an institutional investor to provide a little bit of extra money for the deal, but paid out almost more like debt in my mind than equity.
Yeah, well said. So moving on, we got 8% preferred return. So what happens once that bucket gets filled up for investors? Then it's like, yay, Fair's Capital, we get to participate in some of the profit now. So the remaining equity, the remaining profit, once we pay off everything, then what we do is we do a 70-30 split until the investors get a 15% internal rate of return. So it goes 70-30. So the investors, the limited partners, are actually getting 70% of the next bucket until their bucket is filled up to a 15% internal rate of return, and Fair's Capital will get 30. Now, here's where it gets to be very exciting for Fair's Capital, and where it gets really exciting for the investors, because then Fair's Capital is incentivized. If we over deliver, we do an amazing job, and we get over 15%, anything left over in profit above 15% internal rate of return is split 50-50. And so for most investors, it's like, yeah, great. This isn't annual rate of return. This is internal rate of return. It's a little bit higher. And so, and we'll do a whole other talk on this, the internal rate of return versus annual rate of return. Just know that internal rate of return is it's a very strong, we'll say, metric to be able to measure the overall returns that factors in time. Whereas annual rate of return is just, you invest 100,000 and you double your money. That means you got 20% over a period of 5 years. You got 20% each year, but it doesn't factor in that the time portion of the actual return. And so 70/30 up to an 8% preferred return to our investors. Then our investors, we fill up the next bucket, splitting it 70 to the investor and 30% to Faris Capital until the investors get a 15% internal rate of return. And then our goal is to just knock it out of the park and to just kill it. And then we're splitting any profit 50-50 above and beyond that. And so I can't think of a better structure that protects our investors. But at the same time, like, this is not, we'll call this isn't government or like corporate structure where you die in treadmill, where it's like everybody gets, it's got to be, fair, and there's no incentives for the top performers. For me in the business, John, and you've seen this as well, I know, is that, hey, listen, if you do a great job, you should be incentivized to do a great job. Otherwise, like, this is like, it's not communism, right? And so for us, that's the structure of it. It holds us accountable, where we don't just say it. It's saying, like, you back your words up here with the structure of that. And that's where that 8% preferred return comes. But it's like, okay, here's a huge incentive for you if you knock it out of the park. And that's where, the structure, I just love it. And so as an investor, I love it. And I also love it as an operator as well. There's more risk for us taking on these deals and structuring it this way. But at the same time, there's high amount of we're incentivized to be able to hit it out of the park. And that's our mission.
Yeah, that's it, Mark. And I think that it's important just to note here that when we, for example, Faris Capital Partners presents a deal and we say that there is, say, a 16.5 projected IRR and a 20% annual return, all that math has already been factored in. So it's not like, well, it's a 20% annual rate of return, but then we take away a little bit. So it's not a commission, in other words. It's all factored into these numbers. So we don't even pursue a deal that can't get to that number without, and with all those splits taken into account, we just wouldn't even look at it, just because for us, we know our investors are looking for, really, I would say, outsized returns, right? They're looking for something that's just a little bit of cut above, right? And so that's the beauty of apartment investing, because we're not only taking advantage of the, natural appreciation that generally occurs with real estate, we're actually forcing appreciation through these renovations. So, what we present to our investors is what we're projecting their walk away will be, not, and then our fees are taken off the top. So that's the number you will actually walk away from. So that's really the beauty here, because to your point, Mark, it's total alignment, right? We're we're incentivized to just nail this thing and hit it out of the park, so to speak. And our investors, are able to really predict what they should be able to get out of this investment once we exit it. So it just that clarity point there. It's not 20% and then we take our fees. It's like, this is what we're predicting and projecting with all that math taken into account.
That's really good. It's good insight as well, because sometimes it's like, yeah, here's a return, and then you got all these fees on top of it, and your net return is not there.
That's it. These are net returns we're presenting.
Net returns for investors. Good call there. So I know I briefly went over the capital stack, John, and perhaps you can maybe talk a little bit about the percentages on average of, if you go and buy, say, a $10 million multifamily apartment building, and the percentages of the capital stack of how much goes to, the senior lender, and then on average, kind of, from, if you take on preferred equity, or we'll keep preferred equity out of this, and then we got the common equity as well.
That's right. So generally, and when it comes to the senior debt, which is, the mortgage, to say it simply, when we're looking at that, there are a lot of factors the banks look at. And generally, when we're taking down a new deal, we're working with the government-sponsored entities, Fannie Mae and Freddie Mac. And so they release new guidelines on a monthly basis. So it could be they're factoring in, potential thoughts around the broader economy, what's happening in the multifamily space, and then they actually analyze the actual deal itself. So let's just say we're looking at a $10 million deal that is really run well, so it's cash flowing, which once again, one of our golden rules is we only buy deals that are cash flowing on day one. So for all intents and purposes, all of our deals have this. In today's world, because of just once again economic climate, we're somewhere between 60 and 65, maybe 70% leverage. In certain markets, that number could be as high as 75%. And that's why I'm illustrating today. It's actually a little bit closer to 60, 65%. So in other words, in that example, we'd be taking about $6.5 million down in debt on this property. So that's leverage. That's actually one of the things we love about real estate, that you're not having to buy the full asset for cash. You can actually leverage the bank's money, and then that interest rate's all factored into the economics of the deal in our bottom line. And then we look at net operating income. It actually does not take into account your mortgage payment, just to be clear here. So about 60, 65%. So let's say $6.5 million. So we have to close the gap between that and the $10 million sales price. So $6.5 million, we have to raise at least $3.5 million just to get to the closing table. And then of course we have some fees, right, that come along: the broker fee, the lender fees, etc. But then we also have to raise for the actual CapEx, which is the capital expenditures. So to say it simply, that's the renovation budget. So we're going to put some money into the amenities, the exteriors, the landscaping, and then of course the unit renovations. So, on a $10 million deal, let's just say, probably a $10 million deal is going to be roughly, 60-ish units, 50, 60 units. So we're probably looking at an additional $2 million just for the CapEx on a deal of that size, maybe even 2.5. So that's how it works. So that capital stack, just, to reiterate, you've already touched on it. The senior lender gets paid first, right, at the end of the day. So they're getting their money back. Alongside that senior debt is your taxes, right? Those things that have to get paid. So in fact, most of the lenders, Fannie and Freddie, are not excluded from this. So very similar to a single family home, they actually hold your taxes and insurance payments in reserve. So you're paying a little bit each month, pre-funding those, and then they pay those out. So, in that number is all of that. So that gets paid first. In your point, you said sort of at the top, preferred equity is not something we really do on a lot of our deals, so we can kind of skip over that. But if there were preferred equity, they're next in line. And then just below that is the common equity investors. So in other words, the LP investors and the general partnership. So when we take down a deal, we need to know that it'll cash flow with the new financing, or in some cases, we're able to assume financing at a lower interest rate, right? So in fact, we've been very fortunate there. One of the deals we're looking at right now, as an example, has a 4.44% interest rate. If we were to take down new debt, we'd probably be paying 6.5, maybe even higher. So that's awesome, right? That we have that assumable. But the deal supports that payment. So then it's like about pumping into the investment to increase the NOI, and then that's how we create those returns for the limited partners and the general partnership.
Just quickly, I want to reinforce how important leverage is in real estate, and why more millionaires have been made out of real estate than any other investment. Maybe banking is, if you're in banking, you probably will do better than real estate. I'll give the banking industry, because they get 10 cents in the bank and they get to loan out $1, so 10x through the fractional reserve system. So banking, okay, if you have an opportunity to actually be and own a bank, that's probably going to give you a better return. Now, if you take shares out in the bank, you're not getting the same kind of returns as if you actually are the owner of the bank, where you get to loan out 10x. So you're getting a 10x return. So banking, definitely, John, maybe one day we'll own a bank, and we'll get our investors direct access to the deals in the bank. So, so the real estate is leverage. And so if you're putting down, say, 25%, you can leverage something 4 times greater, which means, so here's the example. You buy a $10 million building. Okay, $10 million building, you put down $250,000, just to simplify this. And let's just say that over a period of 5 years, it goes up 5% a year. So you're at, say, it went up 25%. Well, did your investment go up 25%, or did it go up more? Well, if it went up from, we'll say, $10 million to now you're at $12.5 million, and you put down $2.5 million, 2.5 million, right?
Yeah,
10 million, you got it. Yeah.
You got it.
You did not, your returns didn't go up by 25%. You doubled your investment through leverage. So you buy a $10 million building, it goes up by 25%, and you put $2.5 million down, you doubled your investment. And so
That's
the
right.
leverage side of it, John, I don't know if it gets talked about enough, and why real estate is the go-to, because even like a 5% annual return over a longer period, whatever you put down, you're highly leveraged on that, and that's where you get these killer returns. Not to
That's right.
mention all the tax incentives and all the rest of it, that you're able to generate cash flow, and then we have the value add approach. So it's like we're taking an investment, John, that real estate overall is great, and we're stacking the odds in our favor with all these extra things that we're doing, and partnering that with a strong operations team, the best markets in North America. And then, for us, we're looking at a deal now, John, that we've had to go through. We're just talking about this morning, 300 deals. 300 not this is not 300 apartments that aren't on the market. These are 300 that came across our desk that said, "Hey, I'm listed with a broker. I want to sell it. Are you interested?" And we say, "No, no, 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 no." 300 times, and we got one now.
Yeah.
So when you have that kind of discernment when you're selecting the investments, and you stack everything else on top of that with this, it just becomes so clear and so simple. And that's what I love about these deals, John. It's so simple that if once you get your head wrapped around it, which you can do that it's not an instant thing. You do need to, I'd say, a good hour if you really go through all the questions. And that's why we recorded that on fulloutinvesting.com. We recorded a video that explains everything from start to finish. We talk about how we protect the downside. We talk about the market cycles. We talk about our overall 10-step full out investing process. We talk about our 28 full out investing process as well, where we go in the first 4 weeks and we do a full overhaul and we add value. We give first before asking in regards to raising rents. We stack all this in their favor. This is where, John, these investments, it becomes very, very clear that, okay, I understand why 20% annual returns is not a risky investment, and why capital preservation becomes like, yeah, okay, that makes sense, that my equity that I'm investing in these deals is protected because I know everything that you're doing with that. It becomes very, very clear. And that's what gets us stoked on an ongoing basis, John, and the team that we have as well. It becomes a very clear option to be able to invest your dollars to get ahead and, accomplish all of your dreams.
Yeah, and I think too, banks aren't in the business to lose money, right? And so I think if you look at why would a bank be willing to, lend, 60, 75% of the value of the asset, and it's because historically real estate has been a very stable asset class, right? They know that the property value will increase over time because their risk is, right, if the operator stops paying the mortgage, we're going to have to take this deal back. And so that leverage component, it just speaks to that the banks, aren't offering that as charity. They're offering it because they have no doubt if something goes wrong, they can take that asset over and still get their money back, right? Now, sometimes there's extreme circumstances, right? A total market downturn or something like that. And really, if you look at the Great Recession as an example, that was a total anomaly. It's never happened before in the history of the US or Canada where real estate values drop like that across the board. But what is beautiful, Mark, and I know you talk about this in the video, but if you actually look at rents during the Great Recession, there was a small little blip in 2008 where they went down just a little bit, but then they immediately started rising because housing became more of a challenge. Owning a home became more of a challenge. And so it actually pushed more people into renting. So, really, it's a recession, more recession resistant investment than you can probably find anywhere else because people need a place to lay their head at the end of the night. And our target market of these B and C assets that we improve and kind of take a level up of asset class are going to be where people are looking if times do get tougher, which, could happen, right? I mean, look, recession happens generally every 5 to 7 years, no matter who's in office or what political things are happening in the world. And we haven't had one in a while. I'm not ultra worried about something happening tomorrow, but we know it will come. And that's why we like these investments, because we're investing in shelter at the end of the day, right? And that's, people are never going to not need shelter. So I just love these deals, Mark. I think real estate in general is a great investment opportunity that all investors should be considering, but specifically apartments are just a cut above.
Yeah, right on. So if you are looking for a real estate investment, you love real estate, you're a high net worth investor, and you want to learn more, go to fulloutinvesting.com and you'll get access to our 10-step full out investing process. And you also have a sample deal there as well to find out more what our next potential deal will look like and how they're structured. Thanks for listening, guys. If you enjoyed the show, please subscribe and share with other high net worth investors that you think will benefit from it. Thanks for tuning in to the Multifamily Investor Playbook. We love and believe in you guys. Keep dreaming and investing big.